Welcome to the High Rise Podcast, presented by Headset, the leading data and analytics company for the cannabis industry.
You know, Emily, when I got into the cannabis sector, I never thought I'd have to become, such an expert on the financial system, particularly around banking. But over the years, we've definitely gotten quite a bit of experience in this area. And I feel like over the weekend, the whole tech world is kind of catching up to us here.
Yes, it does. It feels like this happens periodically for us where things are harder for us and then we're kind of like weather tested and then all of a sudden everyone's like, Panic at the Disco and here we come. And then it's like the lament and we're all like, yeah, we're here. But I think it is interesting to kind of and I was just thinking about as you were doing the intro, I used to think quite a bit about banking because American Express was one of my clients for 10 years and they do a lot of work with small businesses. And so I got to talk with a lot of small business owners about how they use all of their different resources. And being a business owner is like every day is a new cycle of something that's happening. But being able to have stable banking is something I think a lot of people in this country in particular took for granted. I mean, let's face it, it's been in the memory of a short-term, kind of memory society. 2008, 2009 is a distant memory, and we'll talk more about that. But I think we should just do a quick retrospective of how cannabis has lived in this banking world and what has happened. So immediately thought of the Cole Memo, of course. I'm sure many people have heard about the Cole Memo. But I thought maybe people don't know really the history behind it. And it came from the U.S. Deputy Attorney General James M. Cole, put together a Cole Memo in 2013. And that it was kind of released. The first memo was released in August of 2013. And basically, it was kind of a bullet point about how businesses can kind of live and be recognized as businesses in the United States, taking seriously that there are people, especially in 2013, it was all medical cannabis. And because this was before January 2014, when Colorado would open its doors to adult use. But prior to that, it had not been taken very seriously. And in this, there's an interview that we'll link in the show notes that our friend Seth Adler did directly with James Cole, sitting in the room with him, which is pretty cool. Back in, I think the interview was done in 2016. But to him, the industry was not being taken seriously, both in terms of the patients and the caregivers who are responsible for making sure that people had access to cannabis for whatever conditions merited it. And so then fast forward to January 2014, Colorado opens its doors. We saw meteoric growth and real interest in the cannabis industry. People had invested into these businesses. These businesses were doing real dollars day after day, lines out the door. I recommend people go back and look at the footage from that time. It was incredible to watch. I remember the excitement very viscerally. But and then in February 2014 came the next Cole Memo. There were actually 3 Cole Memos. And all of these were designed to really aid in providing some structure. I mean, a memo is just a memo, right? It's not law, but it does give some guidance. And what came with the second Cole Memo in February 2014, I remember where I was. I was with my brother. We were looking at the markets and all of a sudden everything just started exploding. And that one came with FinCEN guidance, which basically said, it acknowledged that these companies can work within the state laws that exist and the frameworks that exist. And then FinCEN basically put additional guidance around this to support institutions that may want to work with these companies within the states. And it basically said you have to follow the FinCEN guidelines, which are a broader guideline. But, that did give some comfort to institutions. Now, I would say most of us have experienced a myriad of banking relationships throughout the course of running our businesses, especially like Poseidon was formed in August 2018 when the first Cole Memo came to be. And so we've been here for a while. You've been here longer than me with your time in Leafly. But, I think because of this, the industry has a very close awareness of what goes on in banking and doesn't take it for granted. We've paid a lot to have banking relationships in many ways in time and money. And I don't know. What do you think about all of this, Sai?
Yeah, banking and cannabis is like never ending. But I think it's great to think back to the Cole Memo. It's pretty insane that we've been operating without it for so long. Kind of surprising, not surprising, but I haven't heard much anecdotally from the rescindants and like more challenges coming up. Banking certainly hasn't gotten, really any easier for us. You know, when I think about, what makes banking so hard for cannabis. So there was a memo, and even during the memo, it's not like we could go to Chase or B of A, right? They just didn't want to work with us. And generally it's been the smaller local institutions, credit unions, small state banks that are willing to take on organizations that are in the cannabis industry. And I think it has to do with like the Anti Money Laundering Act and all these requirements that these banks have to have. They're on the hook basically to make sure that all the all the activity that's happening with a cannabis related or marijuana related business is above board. And I think that's a lot of overhead for a lot of companies. Cannabis is such a cash only business, and I think that's where a lot of this comes from, is that because there's so much cash involved, there is an opportunity when you're dealing with cash on like businesses that are primarily cash. There's opportunity to take advantage of that, right? And so I think a lot of banks, to take on that burden, didn't want to do it, right? So it's always been pretty slim pickings for us, even, post Cole Memo. But it was good that we even it got acknowledged, that it was recognized, that it had some ways around it. And then I think after that, that's when we saw more local institutions getting involved. But yet, it's still been, quite a lack of support from the space. And we've over the years, at Leafly we lost accounts. At Leafly we had employees that lost accounts, which was really crazy, and that was very, very early days, um, where just because they were getting paid by us, they couldn't bank. um, and it's always disruptive when that happens, as you can imagine. It sounds, for those that maybe haven't experienced it, or maybe aren't running, a business, it sounds like, okay, well, you lose your bank and you go and you open a new account, no big deal, right? Like, if you're just going to open a savings account or something. But it's actually quite complicated, and the banks, the systems are so integrated into all our systems, like payroll and payments and everything for the business, that it's quite a lot of work to unwind when that stuff happens. And so with this weekend, Silicon Valley Bank, I don't personally know anybody in the space that's there. Maybe they had some. I think we were not allowed in, like many many banks. When with us, even though we're ancillary, it's because a fair amount of our revenue does come from the space. They wouldn't support us. But I think a lot of these, people that all of a sudden saw like what we like a lot of us in the industry have experienced, where oh my god, you're not going to have a bank account here. Since then the feds come in and kind of backstopped it, and I think that it's not going to be as bad as it looked. But it's watching from the sidelines what was happening at SVB kind of was a bit of like, well, now they get to experience a bit of the pain, right? But unfortunately, like, we don't escape it either. It's just double the pain for us still, right? Because even though this is happening at SVB and Signature and other banks, there is a thought that this may continue to um to happen, more consolidation with these smaller banks. And then what does that mean for us as this industry that is already struggling to find support, as just less companies are there, as these companies merge. So it's kind of like, on the one hand, it's like, okay, they got to feel a little bit of the pain, but that just means that we feel double the pain still, which is just annoying. And so the Cole Memo coming through, I mean, that was huge. It got rescinded, which was, I thought it was going to be a terrible disaster potentially. It seemed to be not much that happened from it. Yeah.
It was pretty
Was it
bad,
pretty bad?
actually. Yeah, I think it's funny because there's two ways that had an impact, and I remember because I actually had a phone call with Anthony Georgiadis that day, who's the president at GTI, and this was when they were private.
Hmm.
And the impact on it was that some groups did have banking accounts that they lost just on deposits.
Really?
But
Once that
then
got
what?
rescinded, they
Yeah.
just dropped it.
Yeah.
Wow.
A lot of this is like a soft science, and we're going to talk about how that led to what happened with Silicon Valley Bank falling apart. But I think a lot of it is about the assessment of risk, right? And you pointed out the really important things about KYC AML, which as a fund manager and as a financial firm manager, we go through constant checks and refreshes on KYC AML on everything, on our investments as well as on our investors. Periodically, our administrators will ping me and be like, "Hey, is this LP related to this person who's actually associated with a cartel?" And no one has ever been, but it's just interesting because they're constantly running checks to try to understand the source of funds that are flowing through our system here in the United States. And I think that when it came to that, there was some just quick risk algorithmic things that occurred where people got kicked out of the platforms. But then further to that, that was one of the many times we saw capital, receding away from the industry. And that was what forced a lot of the MSOs to go public in Canada. So it may have felt inconsequential if a ancillary company was able to maintain deposits at a bank, but it did have a definite ripple effect through the industry. And that's where the house the house that we'd built up in Canada on Bay Street with all of the banks up there that decided to accept working with the industry.
Yeah. And then now, I mean, we're still waiting for something, but just earlier this month, U.S. Attorney General Merrick Garland did make a statement that said, quote, "I think it's fair to expect what I said at my confirmation hearing with respect to marijuana and policy, that it will be very close to what was done in the Cole Memorandum." So I think this is just, in the context of what the hell's going on with the federal government and supporting this industry, because that was back in September, October when they made that statement. We were at Hall of Flowers,
Yes.
wherever.
Sep-
I think the announcement over the Hall of Flowers uh, PA system was like, "Weed is legal" or whatever.
legalized
So
weed. We were like, no, not quite.
it's the details, I guess, that matter. Um, and we've still been standing by, right? It's like, well, what's going on? And so, the fact that he says like this stuff is, in the works, and you can expect it to look a lot like the Cole memo, I think is good to hear, and also just good to kind of refresh like what you're saying and kind of go back and look at these things, because that's like a foreshadowing into, well, what's the federal government's like official position going to look like? Well, it'll look a lot like the memo, but maybe in a more official capacity. So it's coming back around. I can't believe it's been 10 years since it was first introduced, and we're still kind of here, but it's good that they're still referring to it.
Yeah, and I think when I think about the landscape where it was introduced, where it was purely medical, and then when it was reintroduced in February 2014, there were two legal states, Washington and Colorado, that were open. Alaska had voted to approve it, but it was not open yet, and now we're so many beyond that at this point. It's just a really interesting shift in the landscape, and does to the point of what James says is about the state laws, following the state laws. So, I think what you're raising is the really interesting thing is, especially, it got rescinded. We have not seen safe banking pass, and the industry lives where it lives. And so many of us who have lost accounts over the years, what have we done? We've put redundancies in place. Our industry, almost every business I know has more than one banking relationship, because you just never know what'll happen. I mean, Poseidon has gone through and I always joke that I'm keeping the receipts, because like someday when we get the reform that we need and we can have a banking relationship, I know who's not getting my money. I very, very clearly, US Bank would be at the top of that list for making us make a shift in such a short time frame. That was the closest we ever came to missing payroll, and it was so unbelievably stressful at that moment. But I think we've gone through a myriad we've lost accounts because someone wrote counterfeit checks out of from us, and so then that raised our risk awareness. Even though, by the way, like I was just saying this earlier, like Poseidon, whenever we open accounts, we always have to present our partnership agreements, our PPMs. Like, they know what we're up to. And so as a financial firm, I think we get a little bit more ability to bank at these institutions, but it has definitely not been easy, and we have redundancies in place. And so, it's funny too, because to your point, was Silicon Valley Bank, did it impact the industry? I don't think directly, because as recently as 60 days ago, I was having a conversation with some folks at Silicon Valley Bank, and I was shocked by the arrogance around the way that they view our industry as so high risk. But in the same breath, we're talking about venture debt, crypto, and these are the things that came to light as the real failing points of Silicon Valley Bank, being over indexed and overexposed. I mean, their chief risk officer had left in April of 2022. I don't know why she left, but she left, and she was not replaced, nor was that disclosed to shareholders or depositors. And so then you see 10% of the balance sheet is in venture debt with no covenants. Covenants are a critical piece to debt instruments. Further to that, they had 16 billion in crypto that they know of, and then there's the whole liquidity issue that occurred around the depositors at the bank, and knowing there could be an issue, because then they had to go out and raise this round of financing in a short time frame, and it all just came to a head. And when I think about what, like, just dovetailing back to what you were saying about like the KYC AML and the underwriting of taking on cannabis businesses and the investment in doing that from their time and resources, I just think these banks, especially something like Silicon Valley Bank, should have done a better job with that. Personally, it's just to expose the bank like that, and then we all know the parade of terribles where the president or the CEO was selling almost $4 million worth of stock in the last 2 weeks. They handed out cash bonuses the day before everything fell apart. But one of the things, so it's interesting because I remember on Thursday when Morgan and I started seeing a meltdown. Morgan and I were both in New York during the great financial crisis. Morgan was at UBS. I was actually working on a consulting project for McKinsey. I remember my friends were getting locked out of, Lehman. People were at Bear Stearns losing their jobs. It was really chaotic. And so on Thursday, this, Morgan and I started seeing what was going on with Silicon Valley Bank. And at first, the commentary was like, is this idiosyncratic of this bank? Well, then there's ways to start digging in on the health of the balance sheets of the other banks, which we always investigate before we put money anywhere. But when you have a limited number of banks that you can select from, sometimes you have to make concessions around those things and take on maybe a riskier institution just as a depositor. But I think what happened here is like the Fed for too long let this market run too hot, and money was essentially free. And I think the underwriting practices were, they were underwriting things as though we were going to be in a low to zero interest rate environment forever. But that we know that's not true. And the minute those interest rates started ticking up, the commercial paper became riskier, and all these things happened. But I think, we got right on it, and every portfolio company that we called, I think with the exception of one, had a redundant banking relationship. And so we felt pretty good by the time Friday was wrapping up that we had people. Now there was, the question of distributing resources across those different banking relationships. And to your point, the logistical challenges of payroll and bill pay and all of the things that you have associated with your primary banking relationship, that really make it difficult. And I mean, even further to that, we were just talking about this too, is like, if your secondary bank or your tertiary bank are the smaller local banks, community banks, credit unions, like, how technically set up are those platforms? How difficult are they to work with in terms of time and money? And like, you as the founder of a company, do you have to literally spend your time going into the bank to do the banking work? It's like all of these things start to add up. But yeah, so it's interesting to watch how our industry has responded to this.
Yeah, what do you think with this stuff? It seems like yesterday it was relatively well contained, even though share prices were plummeting. Is this going to continue to expand? It sounds like, from what I've heard, a lot of these banks look quite similar to SVB in the sense of like what's on their books. And I think that's why, a lot of the stock, their share prices were penalized a bit yesterday.
Mm-hmm.
Does that mean that Are we just going to see more of this? The Fed just backstopping everybody, or do you think some of these guys are going to have to consolidate down? And if they do, what does that mean for our industry, right? Because my biggest fear is that they consolidate into someone who's not favorable, to the space, and then just creates more logistical challenges. Do you think something like that's going to happen?
I had a call with our bankers on Sunday about that very thing, because it is clear that this is going to be a massive consolidation moment. And I do think that poses a concern to me, because some of these banks are relatively large that will work with cannabis, but they've, taken the time to underwrite it. They think the juice is worth the squeeze. But if they're going to get consolidated into one of the top 4 or 5, what happens to us next? And I am concerned about that. It does seem like I feel like we're in such I don't know. I think I'm too old and grumpy. I feel like I'm like Munger inside a younger person's body. But yesterday the market started to rip. Why? Because the Fed probably or maybe or might not raise interest rates again. You know what I mean?
Mm-hmm.
Because of this failure. But maybe the Fed will. We don't know. But I can't believe that in an environment where the banks are failing, which seemed like systemically we had put enough regulation in place to prevent this from happening. I was just listening to the Odd Lots podcast with Steve Eisman talking about this about 2 weeks ago. And here we are today with this very concern happening. This time it's different things that are creating the risk around the bank's balance sheets. And it's not anywhere, I don't think, to the extent of what happened. I mean, that was extraordinary. That was a global phenomenon, what happened in 0809. But I think it's not as contained, as people might think right now. And I think Morgan's been running around triggered since Friday when Yellen was saying things like contained. He was remembering back to the financial crisis when they said this, and there was this quiet lull for a minute, and then the real wave of failures began. I remember I was like keeping lots of cash in like coat pockets in my apartment in New York because I was afraid of like not being able to get my deposits. And at that time, actually, it's interesting that they immediately have stepped up and said depositors will be protected. And I think it's to protect this run on the bank thing,
Right.
which is really actually what accelerated the Silicon Valley moment, was when Peter Thiel's Founders Fund was like, get the money. And then it was just like a fire drill, run on the bank.
Like literally
Just
lines
like back in
outside,
the
like what you're talking about, Colorado, first days of weed legalization, look like that, except it's Silicon Valley Bank. Everyone's lining up
yeah.
trying to get their money out.
Yeah, and these are the things, you saw with WAMU
WAMU, yeah.
back in 0809,
Mm-hmm.
that hilarious bank that failed. And then, or even the Great Depression. Like I remember hearing about physically people were like mobbing the banks back then because that was before FDIC even existed. So it's just a really interesting time, and I think it's a time to revisit, like, what does it mean to be a depositor in an institution? And the FDIC coverage used to be 100,000, now it's 250. That's not enough. I mean, and but we have to, this time around, the banking management teams have got to be held responsible for this. This is absurd, what has happened. But I don't know, Sai, what do you think about this? Like, the consolidation piece is the piece we are going to have to watch for as an industry.
Yeah, that certainly makes me nervous a bit, just given how challenging it is already for our space. And I think the US has, the most amount of, mid-sized banks, small mid-sized banks out there, and it gives us a lot of opportunity to work with a variety of organizations that are willing to take on the risk when it comes to the guidance. And if that number gets smaller, I just see it getting, potentially more challenging for us. So, the federal government, I know they've been working on it. They're talking about it. We're all a little fatigued in it. Are not seeing any real meaningful progress. But I think it is just, one more reason why they just need to get in front of this for this space. Like, because, people say, well, cannabis does have banking, right? Like in the broad macro sense, they'll argue that. And while like technically it's true, it's not really true, and not at the same level, right? And so
Mm-hmm.
we need better structure, um this is a sizable space. There's a lot of jobs. There are a lot of organizations that are all at risk, right? Just like I know a lot of people. I think it was like I saw Colbert, a headline, like his joke was like no one had ever heard of Silicone Valley Bank, and maybe that's true for like the broad masses, but in the tech world, it's like a very, very well known name, right? Massive, massive brand. And so maybe no one's really thinking about the cannabis industry in a macro sense, but there are a lot of people here, right? A lot of jobs, and it's a pretty important piece of the economy. So if it's just continue more risk for us, like that's not great. So I'm sure they've got a lot of bigger fish to fry at the moment, but I think it is something that we need to be noisy about because we don't be left in the cold. If it does turn into like the US is just run by 4 banks that don't want anything to do with us, right? Which is, obviously talking in extremes, and I don't think that will literally happen, but it's what people are saying, right? Move all your money to the big 4, get it out, right? Which is crazy, but if something like that were to happen, we would certainly be out in the cold.
Yeah.
So anything like in between, you don't know, right? How it shapes up, right? Like what it looks like, but there is, I think it's like a non-zero risk that it's going to make it harder for cannabis.
Yeah, I would love to be able to pick Rob Nichols. He's the CEO and president of the American Banking Association. He's been an advocate. He's not, I wouldn't say he's pro cannabis, but he is an advocate for businesses being able to use the infrastructure that has been, thought through and created around banking businesses. And so he thinks we should have banking reform as an industry. I mean, I can't help but like think about what has led to this. I mean, a lot of what has kind of been the trigger point to this was reflecting back earlier in the week, another emerging market, which is crypto, which has been banked substantially, which is hilarious because the whole premise of crypto is to take us out of the traditional
Right,
banking system. And so then what we have here is like what happened to Signature Bank is like Silvergate was the bank that failed earlier in the week, actually prior to Silicon Valley Bank. But in the weeks leading up to that failure of Silvergate, were the large depositors moving their crypto deposits over to like Signature Bank or some of these other groups. And so even if you had, to your point, diligenced the balance sheet when you open the account with the institution, things have happened very quickly subsequent to that, so that have really distorted the ratios in these balance sheets and allocation to risky areas. So I'm trying to understand why that has been such a thing that has been overlooked by the regulators in terms of how they're managing it, because it's like, our industry, yeah, I hear the point, but I actually think like, look, we have the infrastructure in place. We have seed to sale tracking. We have state mandated tracking. Our industry, you can actually rely on resources to diligence and understand whether or not a company is bankable. And many of them are publicly traded now. And so that should lend to another level of transparency. But instead we've been kind of put in the cold, and this other emerging market, which actually poses a pretty significant risk to the banking balance sheets, has been able to just get right in there and be substantial. I still and I'm still mystified by why our banking system, which is is bearing that, considering the concept behind crypto and the blockchain. But whatever, here we are. And I am hopeful that we do have some progress around something. If it is a Cole memo with FinCEN guidance around how to support the industry, that we can get that in place before we see further consolidations of these institutions, because it could become an even bumpier road for the industry than it already is.
Yeah, well said. And look, if this whole cannabis thing doesn't work out, I think we're almost getting to the level where we could just go right into the financial sector, just go into banking, and we're going to be such experts at this point.
Thanks for listening to the High Rise Podcast, presented by Headset. For more information on Headset, visit headset.io.